Okay, now we're ready. All right, so I gave you guys a poll, asked you if you want to learn how to trade news, or if you just want to learn my daily strategy setup that I go through on a daily basis and how I take my trades. And everybody except for like one person voted for my daily setup. So it is a little bit different. It's not the same as like the opening range breakout. It's not EMAs. It's not anything like that. And it's going to require you to do a little bit of homework. It's going to require you to spend some time in front of the charts, do a little bit of studying. What's up, Shadow? So you're gonna have to spend some time, and you can do that this weekend if you have time. Spend some time familiarizing yourself with a few things, but it, that's just what it's going to take. So it's not a simple strategy. It's easy once you get it figured out, but it's not simple. So it's going to require some work on your part. So there are a few concepts. I do trade using ICT concepts or smart money concepts, whatever you want to call them. There are a few things you're going to need to understand, and I'll go over these and try to show you how I do each of these before the market open every morning. The first one is daily bias. You need to have a daily bias. What direction you think the market is going to go for the day. There are ways you can get that from the chart. We'll go over that here in a little bit. Weekly profile is helpful. Again, that's another concept. There are several weekly profiles. To be honest, the reason I say it's helpful is sometimes it plays out that way and sometimes it doesn't. Lately, we've been in such a news-driven market that weekly profile has been kind of pointless, but it's something to keep in the back of your mind. SMT, which is called a smart money technique, it's a divergence between two correlated assets. Fair value gap and inverse fair value gap. Those are simple, pretty easy to understand, and order blocks and breaker blocks. Now, there are plenty of videos on each of these concepts that you can find on YouTube. The two traders that I would recommend you go watch any of these on would be, excuse me, T Trades or Justin Werline. Those two would be the ones that I would watch. I'll go over each of them here, but those would be the two that I would try to keep an eye on. So, all right, let me change over to my chart, and then we'll start to go over some of this stuff here. All right, Okay, so I start off my week on the weekly chart every week. So I go to the weekly and try to get an idea of where we might go. Where did we take liquidity from? What did we leave behind? And I do it on both ES and NQ. All right, so get those side by side. Try to take a look. I got everything off there. And you'll see that this week was a disgusting week. We're finishing the week as a doji. I mean, that means we had a choppy, terrible week, which I think everybody can attest to. Yes, we had a choppy, terrible week. So going into next week, we're going to look at, okay, what kind of liquidity do we have? Are we nearest to? And liquidity is another concept you need to understand. So you have two types of liquidity. You have external and internal. Okay. External liquidity is old highs and old lows. Internal liquidity is going to be fair value gaps and order blocks. Okay. So what we do have here on the weekly, we have an inverse fair value gap right here. So that serves as an area of support. We didn't quite inverse this one, so I'm going to leave that one unchecked. But a fair value gap, for those of you that are wondering how we have an inverse fair value gap, a fair value gap is a 3-candle pattern where you have this high of this candle right here and this low of the next candle don't overlap. And so there's this gap, an inefficiency in price right here. And that usually means the price is aggressively going in that direction, which is the case here. Price aggressively went up, left behind a fair value gap. But there's one directly opposite of it as well. And so the fact that we went through this inverse fair value gap, which initially this served as an area of resistance. You can see we created the fair value gap. Price went up and retested it and pushed back down. We came and created new lows. Now we went back up and went through that. Now it should be an area of support. Okay, so resistance becomes support, support becomes resistance, same kind of thing. All right. So what initially was an area of resistance is now an area of support. We didn't quite take these highs, and we're starting to curl over. So I'm thinking, I don't know this, but I'm thinking that sometime in the next couple weeks, we'll curl back down, retest this area before we go back up. All right. But that's a weekly thing. So I'm just that's weekly. I'm not really looking to take a trade off this, but it's an area that I want to know about. So this would be where I would start my Sunday, just looking at this. Like, okay, fair value gap, inverse fair value gap, right here. We didn't take that high yet, so we did go up and take some internal liquidity there, and this would be technically a weekly order block right here, which served as an area of resistance. And there's something key about this that I'll explain to you guys. So an order block in this area, we got a swing high that was created. The two up close candles before a downward engulfing move. So this is our order block. These two up close candles.
Are closed.
Thank you. I'm glad the market's closed. These two up close candles before the downward engulfing move, that creates our area of resistance. Now you can see this dashed line, that is the halfway point. The halfway point of any area of interest, like an order block, breaker block, fair value gap, inverse fair value gap, are always going to be key areas to look at. And one of the things that you need to understand about price is that wicks do the damage, but the bodies tell the story, right? So the wicks do all kinds of damage, but the bodies tell you where price is actually going. So price, the bodies, closed below the halfway point. And then again, we went up and retested the same area, didn't even get as high as the previous week, and came back down and closed below. So that tells me that this is still a valid area of resistance. We're probably going to come back down. If we retest an area, it's likely going to be here. So next week, I would be targeting this green box, okay? But that's just to let you know my thinking going into the week. I know I'm kind of flying over some of these concepts, but it is going to require you to do some study on your own. Because if I tried to go through in detail about each of these, we would be here for a really, really long time. And I don't want to do that to you guys on a Friday. All right, so we got order block, inverse fair value gap. We're going to this area. We're probably going to reject. Next week, we should likely come down into this area. Now, had I, really been paying attention, and I not just told myself I wasn't going to trade today because it was quad witching, this is something I probably would have charted out last night or earlier this morning, and expected some downside, but I didn't. So I did take a short early this morning, and I'll go over exactly why that was. Okay. So if we go to the daily looks like this. I mean, we've been fairly directionless for a while, so kind of gross, nothing fantastic there. If we go look at the 4 hour, now we start to see that we do have some direction. We did respect this inverse fair value gap here. That's what we bounced off of earlier today, which made me think that with any kind of news, we were probably going to go up and take this high, but we didn't. We just kind of came down and then chopped sideways all the rest of the day. So this was our draw on liquidity, was this area down here. Our initial draw was these highs, and then we have this down here. So something else I'll be looking at next week. You see these equal highs right here? How they're almost at the exact same spot? I mean, are they the exact 136.50? This is one tick above here. This is an area that I'm going to keep an eye on as a draw for liquidity for next week. Anytime you get equal highs like that, it's like a magnet for price. So that's something that'll serve as our buy side draw. Okay. But then going into today, I basically just had the 15-minute chart and used that. I took shorts, and the reason for that is because we had these highs right here that were kind of equal highs. And this is going to be the next concept to talk about. And this is the easiest one to understand. Right? This concept is super easy. It's called SMT divergence, and I don't take a trade without it personally. I know people say you can and that you're missing opportunities. That's fine, whatever. I just know what's worked for me. And I didn't mean to do that, but I did it. I know what's worked for me, and so that's what I do. So if we look here, we got this chart. You can see my cursor is over the same area on NQ and ES. So that's how we have the swing high on the 15. NQ takes the swing high, as you can see by this green line. ES does not. So what I was watching, since this is the 15-minute chart, I go down to the 1 minute. And now I'm looking for an opportunity to take a trade. I'm looking for some kind of reversal pattern, market structure shift, some kind of break in structure, some hint that price is going to go the other direction. All right. So what we have here, we get NQ above this high. ES obviously isn't there. So I'm watching. I'm waiting to see if maybe ES is going to catch up. NQ starts to make this swing low. ES is making this swing low over here as well before it gets to the high. And I think, okay, well, we've got a higher high, higher low. If we create a lower high and a lower low, I'm going to look for an opportunity to go short, which we did. So this is our market structure shift right here. We get a close below this low. We also created a fair value gap. As soon as we created this fair value gap, I went ahead and got short, because what you'll find, especially lately, is price doesn't go back and retest levels a lot of times, frequently, not anymore. And the other reason is because we have a breaker block, which is right directly opposite. So swing low, it makes the order, it is validated as an order block in the push up, and then it comes down and gets closed through. So now it's a breaker block. All right. So we have SMT divergence, we have market structure shift, we have a fair value gap, we have a breaker block. Price goes up, retests the breaker block, and absolutely dumps. But this is where I got into my trade, was right here. Let's see, I can go down and pull it up for you. What is that? 22,105. So yeah, I got in up here and got out. So right in this area, so 22,105. I guess I got in on the dump down before it even got there. I got a little ahead of myself. I do that sometimes. But this is the exact setup. This is the kind of thing I do every morning. So I look for SMT. Then I get market structure shift. I have a fair value gap. I've got a breaker block. There's our retest on the breaker block. And then boom, dump down. Now, a lot of times what ends up happening is you'll see something like this where we pumped all night off some kind of news. The 9:30 candle comes out. You'll get a push down. And we have an order block right here. So I'm thinking, okay, I'll get on the order block. I didn't do it today, but a lot of times I do. I'll take this. The reason I didn't was because we were so close to this line that I thought, man, I'm going to wait and see if ES closes above this. A lot of times I would have taken this. It would have come out and I would have gotten stopped at a break even, and then would have maybe taken it the other way. Or if I would have been cognizant enough to see the SMT and this reversal, I would have taken the short. But there's obviously a lot that goes into it. I know I threw a bazillion concepts at you guys, but the easiest way I can make it is you're going to look for an SMT, which is a divergence between NQ and ES, just like right here. 15-minute chart is where I typically watch for my SMT. You can see them on the 1 minute, and there are times where I'll take one based on a 1 minute SMT because it kind of provides some extra validation, but you don't always get one. So I like it when we take a higher time frame level on one and not on the other. And in this case, that's what happened this morning. And I was able to take these and go with it. But so SMT is the easiest one. That's just divergence. You have, I guess for those of you that have used RSI and stuff, you're used to seeing divergences. This is just a divergence in price. It's very, very similar to an RSI divergence. And you can use it that way. But then there are some other concepts you're going to need to make sure you get, like order blocks and breaker blocks. fair value gaps, inverse fair value gaps. You don't have to make it super complicated. There are people that will tell you you need to know where midnight open is and this and that and all that. I mean that's fine. Midnight open's great because statistically, according to Edgeful, midnight open gets revisited some 70-something% of the time over the course of the day. Now, in this case, we dumped right through midnight open, and we created a bunch of bearish structure that says, you're not going higher today. I thought maybe earlier today on this candle, we went into a 4-hour inverse fair value gap on NQ. I thought maybe we would push off of that and go higher, and we didn't. But that's my entry. Now, what I'm looking for in terms of take profits when I get into this trade, all right, I'm going to look for this wick low. That'd be my TP1. And I would set one take profit there, and set sell side liquidity. So we're going to mark that. It's the wrong one. Sell side liquidity, I'm going to mark that green or red. Blech. And then for TP2, it really depends on how aggressive you want to be. I tend to be more aggressive than most, but I would have set a second one here. And then I would have held until, after we broke this low, I would have just been holding short probably the rest of the day. I would go to a higher time frame. We'd go to the 1 hour and see if we can find something there. So yeah, you got these hourly lows. So this hourly low right here, would have taken some there. And then you've got this hourly fair value gap. So you'd want to probably take another one before you got there if you're in multiples. And then we just chopped around. So that is, I know that was a lot of stuff I threw you guys. What can I clear up for you? Because I'm sure there are going to be questions. New York taxation saw it this morning. You were scared? Oh, man, I get it. It's kind of like stepping in front of a train, but the SMT is what gave me the conviction to do it. For sure. Yeah, sounds good. Yeah, I totally get that. It's when you're first learning this tough because you're really trying to make sure that you understand what's going on. But when you see, if you go back and look at the hourly, tell me that's not a bearish candle on the hourly. You could have just taken shorts on the next hourly candle just based on this one. But one of the things too that you guys need to understand is time frame alignment. So I'll put this, let me switch my screen here. And we'll go over some time frame alignment stuff. Let's do this. That's not what I wanted to do. Where is it? The time frame line if I get Discord to cooperate with me. Jeez. It's not wanting to cooperate. All right, so time frame alignment. Let's add that in right here while we're talking about it. Alignment. Okay, so you go to the daily, 1 hour, and 5 minute. Then weekly, 4 hour, 15 minute, and the 1 minute. All right, and so what you're looking for when you see an important level, and it's an important daily level, then at the very least, what you're going to want to do is see a 5 minute reaction from that. And what I mean by reaction is an inverse fair value gap, a market structure shift, some kind of verification that price is changing direction. If just because you see a 5-minute wick, that's not enough. You need to see some 5-minute structure start to show you that, hey, we're changing direction. That's at the very least. Ideally, you want to get a 1 hour. And if it's an hourly level, then you want to get a 5-minute. If it's a weekly level, you want to see a 4 hour. If it's a 4 hour level, you want to see a 15-minute reaction. If it's 15, you want to see a 1-minute reaction. Okay. That's time frame alignment. So study these concepts: daily bias, SMT, fair value gap, inverse fair value gap, order block, and breaker block. And everything will start to make sense to you. But what you'll notice is at 9:30, when the New York Open happens, it's typically going to be a manipulation move one direction, and then you're going to reverse the other way the rest of the day. Typically, unless there's a higher time frame area of interest in the opposite direction, which you could reject and bounce from or whatever. But that's my process. I do mark out a few different levels that I didn't put on my chart that I guess I'll show you now. Let me do that. Okay. So based on this, I think initially we moved down next week into that green box that I had posted earlier. But we could gap up over the weekend because Trump could come out and say free whatever to whoever, and that kind of is what it is. That's why I don't try to do much in the way of predictions anymore. But all right, so we're gonna have some make-believe time frames here. Well, actually, we'll just chart what this would look like when the market opened today. Okay, so we have our daily open here. I always chart the daily open, and in this case, we didn't have a wick at the bottom of the daily candle, which is kind of unusual, but it does happen sometimes. Right here is 9 p.m. It's when the Asian market opens, Tokyo. So that's our Asian low. Right here at 4 a.m. would be our London low. And the reason I'm not marking an Asian high is because I can already see that London took the Asian high. So that doesn't really make a lot of sense. All right, London, 8 a.m. So there's London high right there. You can see that NQ wicked through that. I'm pretty sure ES did too. Yeah, I mean, ES went through London high too. But we closed below it and came back down. Now, one way and that's how I mark my charts. I do mark the previous day's high and low as well. But yesterday was a holiday, so I don't really pay much attention. When the previous day's a holiday, I don't pay much attention to that range. Personally, you guys obviously can, and you can do what you want to do. But what you can do is you can look at high time frame candles like this, and this is how you can get bias for the next high time frame candle. All right, let's just get all this stuff up here and we'll look. So in this case, we go up, we go above the high, and then we close back below into the body of the previous candle. So the bias, especially if we look at this and we see daily, we're going to think, okay, well, the next one should be a down close candle, with this being the minimum draw on liquidity would be the wick down here. So we go up, wick into the body on this hourly candle, and then we just absolutely dump all the way down. If you're trying to get daily bias, that's an easy way to do it. You look at the daily, you say, okay, we took the previous day's high, closed above, we should go up. We took the previous day's high and closed above, we should go up. We go up, we come back down. And now we look at that and we think, okay, well, we took the previous day's high and then we closed back into the range. We should probably go down. And boom, big down candle. Wicked below, should go up, come back down. Inside candle because it's inside the wick. This one, which when you get an inside candle like this on a high time frame, maybe you want to go to a higher time frame and see if you can see something, or just trade the lower time frame. You could kind of trade the break. Hey, if we take this high and come back down, then I'm going to go for the low. If we take the low and come back up, I'm going to take the high. Whatever. But there's a lot you can read just by looking at candles. You can see I don't use any indicators. If you sit in high roller with us and watch, and my screen's on up most of the time, I don't use any indicators. I try to trade price and see what price is trying to tell me. And the reason for that is because indicators lag. Indicators, if you're waiting on EMAs, if you're waiting on VWAP, if you're waiting on whatever, those are going to be behind. And I want to try to get in at the best place because I'm trying to reduce my risk. 2, I'm trying to maximize my return. So I want to make sure that I'm getting the most bang for my buck without exposing myself to too much risk. And, EMAs and VWAP, VWAP is less so, but EMAs and a lot of other indicators, the lines they throw in the charts are kind of arbitrary. I used to use the 9 and 21 EMAs all the time. And so I would take an entry off a retest of the 9 and put my stop loss, depending on where it was, maybe on the other side of the 21. But most of the time I'd put it on, a body close on the other side of the 9 and just to watch price bounce from it and take off. And I always wondered, like, man, how can I fix that? How can I make that where I get better entries? I don't have to wait for it to cross the 9. How can I see these levels a little bit better? And I learned support and resistance, and that helped. And smart money concepts really are kind of like support and resistance in a tuxedo, more or less. Fancier support and resistance, but they can definitely open your eyes to markets. Now, there are a lot of other concepts that I use that can be beneficial. Those are the main ones that you need and are really important. No, man, I look for SMT on the 15-minute and up. So I do occasionally look on the 1, but if you see a really high time frame SMT, like on the weekly or the daily, even the monthly, you're about to get a really big reversal. Now, in this case, we don't have one. I mean, they're very correlated. They both took the previous day's low and closed above. Previous day's low closed above. And then, even the one before that, they both took the previous day's high and closed back in the range. So, no high time frame SMT, but we had a 15-minute and maybe an hourly SMT. But when you see it where like NQ takes this high, maybe say, for example, if we had closed today and NQ takes this high, but ES is down here, a lot of people would be thinking, oh man, we're about to go to all-time highs because we got this up here, but ES is lagging. So you're going to want to get some verification. You could still play longs as long as you have long, upside structure, but you're going to want to be very mindful as soon as you start to see a reversal signature start to happen that, okay, ES didn't get there. We're probably going to go back down and retest. And I don't want to get smacked. So does that make sense? All right. So 30 minutes. I'm sure I confused the living crap out of some of you guys, and I'm sorry if I did, but if you have questions, feel free to shoot me a DM. Let me know. I'm definitely more than happy to help you guys out. Obviously, I'm in live all day, every day, and you can ask there. I do